Welcome to our CFP exam prep discussion on state-level insurance regulation. Today we're diving deep into a crucial topic that often trips up test takers, but understanding it will significantly boost your exam performance. Let's start with a fundamental truth. Insurance regulation in the United States operates primarily at the state level, not federal. Each state has its own insurance department or division, headed by an insurance commissioner or director. These state regulators have substantial power over insurance companies operating within their borders. They oversee licensing, monitor financial stability, review policy forms, and handle consumer complaints. The National Association of Insurance Commissioners, or NAIC, plays an interesting role here. Think of NAIC as a coordinator rather than a regulator. They develop model laws and regulations that states can adopt. But here's the key point many candidates miss. NAIC has no direct regulatory authority. They can't force states to adopt their recommendations. They're more like a highly influential advisory body. A common exam mistake is assuming NAIC has enforcement power. Remember this scenario. If an insurance company violates regulations in Florida, it's the Florida Insurance Commissioner who takes action, not NAIC. NAIC might provide guidance, but they can't impose penalties or revoke licenses. Let's break down the main components of state regulation. First, states control company licensing. Insurance companies must obtain separate licenses for each state where they want to do business. Second, states regulate policy forms and rates. They review and approve the actual insurance contracts and pricing structures. Third, states monitor financial solvency. They require regular financial reporting and maintain guarantee funds to protect policyholders if an insurer fails. Fourth, states handle consumer protection, including investigating complaints and enforcing fair trade practices. Here's a practical example that often appears in exam questions. An insurance company based in New York wants to sell policies in California. They can't simply start selling because they're licensed in New York. They must obtain separate California approval, comply with California's specific regulations, and submit to California's oversight. Another tricky area is understanding state variation in regulations. Some states are more stringent than others. For example, New York is known for particularly strict insurance regulations, while others might be more lenient. The exam might test your awareness of this variation without requiring specific state-by-state knowledge. When studying this topic, focus on the broader regulatory framework rather than memorizing individual state rules. Understand that state insurance departments have primary regulatory authority. Know that NAIC provides models and coordination but lacks direct regulatory power. Remember that insurance companies must comply with each state's specific requirements where they operate. A final common mistake is confusing federal versus state oversight. While some insurance aspects face federal regulation, particularly in health insurance through laws like HIPAA or the Affordable Care Act, the core regulatory framework remains state-based. Don't let questions about federal insurance programs lead you to assume federal regulatory authority over general insurance operations. Use this mental framework when approaching exam questions. Always consider the state-level perspective first. If a question involves regulatory action, think state insurance department, not federal agencies or NAIC. This approach will help you navigate through some of the trickier questions you'll encounter on the CFP exam. Remember, understanding state-level insurance regulation isn't just about passing the exam. It's fundamental knowledge for your future practice as a financial planner, helping you better serve clients navigating the complex world of insurance products and regulations.